Hi guys, I'm Karunya Rao and in Ideas for Profit, the spotlight is on Infy's Q2 performance. Technology is presenting unprecedented opportunities for IT companies, and it's heartening to see the execution engine running in full throttle amid tremendous supply-side pressure as demand for talent far outstrips supply. This was the central theme of Infy's earnings report as well. Strong broad-based revenue acceleration, operational efficiencies shielding margins despite supply challenges, and strong commentary on demand prompted Infy's management to revise its guidance upwards. Now, these were the key highlights of a seasonally strong quarter. With the stock underperforming the Nifty and the IT index in the past 3 months, we see a catch-up in the stock performance and likely closure of the valuation gap with Bellwether TCS. The stock remains a great core portfolio company to be added on every decline. Revenue of $3,998 million grew by 5.7% sequentially in reported and 6.3% in constant currency, the best constant currency growth in the last 6 years. The year-on-year growth of 19.4% in CC terms was the best performance seen in 11 years. The growth was broad-based and key markets of North America and Europe exhibited strong growth YOY as well as QOQ. All 7 key industrial verticals also saw sequential as well as YOY growth. Manufacturing was especially strong thanks to the ramp-up of the large deal from Daimler. Strong execution, robust deal pipeline and revenue visibility have prompted the management to increase the full-year FY22 revenue guidance to 16.5 to 17.5% from 14 to 16% growth in constant currency terms indicated earlier. We see the guidance hinting at a softer second half compared to the first half. The share of digital in total revenue grew to 56.1% and the same showed a YOY growth of more than 42% in constant currency. Higher share of digital is causing a positive rub-off on revenue per employee that has risen 7% year-on-year. Despite a wage hike causing 110 basis points drag on margins and supply crunch leading to higher outsourcing that pulled down margins by another 50 basis points, Infosys managed to restrict the sequential margin decline to 10 basis points only thanks to gains from operating efficiency, scale benefits on sales and marketing, and cross-currency tailwinds. Client metrics remain strong, with the company adding clients in the $100 million, $50 million, $10 million, and even $1 million bracket. The overall share of top 5, top 10, and top 25 clients in total revenue improved, indicating market share gains due to better client mining and vendor consolidation. Meanwhile, hiring continues to reflect optimism on the growth front. The company added 15,000 freshers from campus in Q2 and plans to hire 45,000 freshers in the year, up from its earlier target of 35,000. The management expects pressure on margins in the near term from supply-side challenges. It's also affecting compensation revision for senior management and key talent in Q3. This, coupled with seasonal revenue weakness of Q3 due to furloughs, make the near-term outlook subdued. Resumption of travel could also eat away some of the post-pandemic margin gains for the company. Hence, retaining the margin guidance band to 22 to 24% doesn't come as a surprise. Given the tight labour market, the company saw a steep spike in attrition from 13.9% to 20.1%. In the absence of mega deals, the large deal wins, which are greater than $50 million, at $2.15 billion looked rather muted, and the share of net new deals at 37% was a bit unimpressive. Now, if one were to compare Infosys' performance with that of TCS, Infosys has clearly stolen the show in the quarter with much superior growth and is fast closing in the erstwhile wide valuation gap with TCS. Long-term investors should look beyond the noise of supply crunch. The point to focus on is the multi-year technology upcycle, which according to most industry leaders is just at the beginning. While the sudden surge in demand has created a never-seen-before supply shortage, with aggressive hiring of freshers and reskilling, bulk of the problem should get addressed and stability is expected in a few quarters down the line. We believe a market where demand outstrips supply, large branded names are relatively better placed to attract talent. As of now, pricing is also stable. And going forward, pricing uptick could emerge as a tailwind for margins. We see a strong highway of growth and recommend adding Infosys stock on every decline.